Thank you, Gavin. I'm here to talk about corporate tax changes, and there are some big corporate tax changes to announce. So it's good to stand here and have something to tell you about today. I think the first thing to say is we have a headline change in corporation tax rates. Probably the biggest announcement yesterday, and let's face it, we knew there'd be some bad news along the way, and the bad news is that corporation tax is going to increase from its current 19% through to 25%. Good news, though, is it doesn't take effect until the 1st of April 2023. So between now and then, we continue to pay and enjoy the current 19%. There is also a small company threshold for the first £50,000 worth of taxable profits, so they will remain at 19%, and then it will gradually increase up to the full 25% as your profits reach up to £250,000. Now, this does feel like we're going back in time, where we had different tiers of corporation tax of £300,000 small company rate and the large rate at 1.5 million. So the new limits and those historically have always been shared between associated companies, those under common control, and these new announcements are no exception. So we do need to divide those limits between associated companies. We don't have detail as yet as to how the marginal relief will work, but it's anticipated that this will work very much in accordance with the old rules, whereby you have different hybrid rates of tax depending upon your chunk of profit chargeable at each rate. So this is not simplification in any way, shape or form. And for many, remember, incorporation has been a really good tax planning opportunity. Will it continue to be the case when we have a 25% corporation tax rate? Something to consider for the future. So historically, UK corporation tax rates back in 2008, they were up at 30%, and they've been reducing down. And remember, they were due to reduce down to 17% in 2020, but actually this was cancelled, as we know, and it remained at 19%. Remember the Conservative manifesto, the triple lock of no increase to income tax, to national insurance and VAT. So I think it was pretty clear that corporation tax was a perfect way for them to raise taxes in some way, shape or form. So let's look at our tax rate compared to the rates across the globe. These are how they currently stand. So with our 19%, you can see that we're very, very competitive, and many of our neighbouring countries, including Germany and France, have much significantly higher corporation tax rates. Now, if you look at this after the 25% announcement in 2023, it still has a very low and competitive corporation tax rate, and the lowest rate in the G7 countries. And I think also because we have the small company limit as well for the 19%, the true 25% doesn't roll out to all companies. My only observation here is that COVID is a worldwide pandemic, and the rates that we see could well increase globally in other nations too. We know that the US is certainly planning to increase their rate during the term of their current government from 21% to 28%. But it does demonstrate that even at 25%, the UK remains well placed to encourage investment and to do business. Some other announcements, trading losses due to COVID. So Hmrc clearly recognise that business is not as people would like it. And if they have made losses, they're making tax relief available more readily and more easily as a result of the losses caused by COVID. So this is going to be legislated in the Finance Bill 2021 and will temporarily extend the period over which incorporated and unincorporated businesses can carry back trading losses. So looking at corporate taxes first, so corporate losses, they can be carried back and not only 1 year but back to 3 years now, and the amount of the trading loss can be carried back to the immediate preceding year remains unlimited for companies, but if you take it back on a last in, first out basis into the earlier years, there's a limit of £2 million in each of those years, but still a very generous relief, I think it's fair to say. And where a group exists, that £2 million is to be split across all group companies, but there is an overriding £200,000 minimum limit for each company, so it could extend over 2 million if your group is large enough. Some things to note, though, it does seem to be for trading losses only, as far as we can tell. Note that it includes accounting periods ending between the 1st of April 2020 through to 31st of March 2022. So this means that pre-COVID losses are effectively going to fall in this regime, which is quite generous. But as ever, more detail is needed. We don't have the detail, we don't have the technical stuff at the moment, I'm afraid. For an unincorporated business, again, there is a £2 million cap to carry back of losses, but the current restrictions to carry back losses from a trade against the general income in the preceding year it very much remains, and it's only where you carry back to profits beyond that in the two preceding years that you need to look at trading losses only. If not, you can allocate against total income, not just trading income. And I think the other thing to say is that that £2 million limit is a personal limit. So if you're a member of a partnership, it's not the level of the partnership loss, it's a personal loss that is allocated. Capital allowances, and again some big changes here. This is just a quick reminder of where we are at the moment. We have an annual investment allowance of £1 million on the first £1 million of your capital spend that gets 100% tax relief in the year in which you incur the expenditure. We expected that to revert back to the £200,000 limit with effect from the 1st of January 2021, but back in November they extended that for a further year. But now we see some further changes. Currently we have the plant pool at 18% and a special rate for integral assets at 6%, I should say. And there's also a structural buildings allowance available of 3% over just over 33 years on a straight line basis. And I just want to touch on structural and buildings allowances for a moment, because this is a relatively new allowance and I want to highlight that most things qualify, but the land and the associated costs with its acquisition do not qualify. It's a straight 3% allowance on a straight line basis, and regardless of the proceeds, if you sell the building, there is no balancing charge. You just carry forward to the person acquiring the building the unused allowances over the just over 33-year lifespan of the building. But what did we hear yesterday? We heard about this new super deduction. The super deduction enhances your capital allowances. It's a first year allowance. It kind of replaces the annual investment allowance, but it doesn't kick in until the 1st of April this year. So until then, you can continue to use your annual investment allowance. But what this effectively does is, for every £100 of capital spend, you get £130 of tax relief on it. So it's a really super allowance to use, and that's where you have main rate assets, so plant and machinery ostensibly. Where you have an asset that will qualify for integral assets at the 6% current rate, you will get 50% first year allowance, so not quite as good, but still a significant enhancement on the 6% you get at the moment. But note, this does exclude cars, used and second-hand assets as well, so it does mean you need to buy new. What will the effect be on second-hand vehicles and second-hand plant and machinery? There is a bit of a sting in the tail, but I don't suppose it's unreasonable really, and that is to say that if you sell an asset upon which you've had 130% tax relief, then your disposal proceeds are similarly enhanced by 130%. So this means that you effectively pay tax as a balancing charge on a higher level than you would do of the actual proceeds you receive. But if you've had the tax relief at 130% at the outset, you could argue it's only fair to do that. But just thinking about that, where you acquire a piece of plant and machinery that qualifies for this new super allowance in June 2021 and you get your enhanced tax relief, you sell it in 2024 when corporation tax is up at 25%, you could actually realise a balancing charge at a much higher rate of tax with a similar 30% enhancement as the rates of corporation tax increases. So planning is needed, without doubt, but it does seem to be a very good allowance and certainly will encourage investment, and that's exactly what Hmrc and the government are planning as a result of that. So, capital allowances and cars, this is just a quick recap really, because we're asked this question all the time. With the continued drive for fuel-efficient cars and low CO2 emissions and electric vehicles, The rate of capital allowances that you get on a new car does vary and are set out in this slide. And remember that cars do not qualify for annual investment allowances, and neither do they qualify for the new Super Deduction either. Cars are specifically excluded. Car, van and car fuel benefits increased very slightly in accordance with the September 2020 Consumer Price Index, and also a zero rate for zero carbon emission vans. The Cycle to Work scheme, some temporary relaxation of the rule whereby you have to use the bike to commute to work for at least 50% of your time. Obviously in COVID times, working from home, this has not been possible, so they've relaxed those rules until 5th of April 2022. Research and development allowances. Well, the government want to invest 2.4% of GDP by 2027, and we've seen these headline messages over the last few budgets, and these continue to be the case. The changes this year, well, really the only change is the cap of £20,000 plus 3 times your pay-as-you-earn and national insurance liability has been introduced. Effectively, this applies where your enhanced tax relief as a result of R&D is surrendered for a tax credit with Hmrc and Customs. And effectively, they're limiting how much tax you can get back now. It was unlimited until now, but now they're saying you can have 3 times the level of pay-as-you-earn and NIC that you deduct for your staff, plus £20,000, but no more. They're going to expand and consult once more on research and development. They've only just finished a consultation back in the autumn 2020, but they've announced a further one. They're looking to expand the relief. There also could be some tightening of the rules as they believe they may be abused in some circumstances. But the headline here is that the government want the UK to build and grow its R&D activities and initiatives, can continue to promote these annually. It is great tax relief. Off-payroll working. These rules do come into effect from the 6th of April this year. They've been kicked down the road a few times. They were first announced back in 2018, but they do take effect from 6th of April this year. They were due to be introduced last year, but kicked back to this year. But they are here and they are upon us now. So if you are a contractor operating your own company, or you engage the services of such a contractor, make sure you take advice and make sure you know what the changes are and how they will affect you, because the financial impact is huge. A contractor on a daily rate of £600 needs to charge £677 to get the same the same net pay into their pay packet, and that's enhanced further by national insurance for the engager. And remember, the responsibilities fall to those engaging these people to get it right. So please take advice. So, corporation tax payments, something they did sneak in yesterday, is the timing of corporation tax payments. So at the moment, they are paid 9 months and a day after the year end, unless you're a large company or a very large company, where your tax are paid in quarterly instalments. For a large company, they're just over 6 months into the accounting period, and it's the second consecutive accounting period in which your profits become large, large being defined by 1.5 million divided by the number of 51% group companies. For very large companies, the limit is £20 million, but there's not a year's grace. The year in which your profits go over that £20 million divided by the number of group companies is the year in which you need to start paying them, and you pay them 3 months earlier than the large company rules, so it's just 3 months into the year and quarterly thereafter. And remember, I've just explained that 51% group companies share those limits, but they're changing that to make it associated companies from April 2023. So what this basically means is all companies under common control will be taken into account when you're dividing up those limits. That will effectively mean many, many more companies will be paying their tax in quarterly instalments. And just a reminder that a company will be associated to another company where one company has control of the other, or both companies are under the control of the same person or group of persons. And the final subject I just wanted to touch on today was really some Hmrc administration points, because they continue to tackle the promoters of tax avoidance and try and stamp out those that are promoting aggressive tax avoidance schemes, and they continue to do that. The general anti-abuse rule, they're working very hard to make sure that continues as it is intended. And there's also introducing this year some tax conditionality for certain workers and sectors where there's been perceived historical no tax compliance. And those areas are private hire and taxi firms, as well as scrap metal dealers, who will need to demonstrate their tax compliance in order to get their operators licenses. So that's quite a distinct change and further crackdown without doubt. Income tax self-assessment and VAT late payment and interest regime is set to change for VAT periods starting after the 1st of April 2022, and for income tax self-assessment where property or business income is over £10,000 from accounting periods after 6th of April 2023, and for all others from 6th of April 2024. And what this effectively means is that there'll be a points-based system, and that points-based system will charge a £200 penalty where it's breached, and there'll be a new tiered late payment for late submission and percentage tax penalty proportionate to the extent of the late submission. And also the interest rates and repayment interest on VAT will be aligned with other tax regimes. Further investment in Hmrc of £180 million, yielding some £1.6 billion by 2025-26, is going to be introduced in technology and further crackdowns on compliance and the digitalisation of business rates. But the thing I really wanted to highlight to you is that the government will invest over £100 million in a taxpayer protection task force of 1,265 Hmrc staff to combat fraud within the COVID-19 support packages, representing one of the largest ever responses to a fraud risk by Hmrc. They will also raise awareness of enforcement action in order to defer fraud, and will significantly strengthen law enforcement for bounce-back loans. So that brings me to the end of our technical talks and presentations, and I really hope that you found these useful and insightful. I would like to thank all of our speakers, our great marketing team here at Scott & Bland, and also our AV partners today, Hart Wilcox Limited, who are hosting us in their green room. Thank you. There was a feedback questionnaire, a link for which is just under the list of presenters on your web page. Please follow this link and take a few minutes and seconds to complete this. We would be most grateful. And just below the feedback link, you can see the links to our breakout rooms, which will open very shortly. As mentioned earlier, all our presenters will be available for your questions, so please click through and catch up with any of our speakers for further advice or information, and we will be online here until 10 o'clock this morning. We have sent to you, for those that registered in time, of course, through the post, a Scott & Bland insulated drinks bottle as a token of our thanks for your continued engagement and support of Scott & Bland. I hope you find this useful. There was also a postcard reminding you of all that we do and how we can help, so please take a fresh look at that if you've not already done so. I sincerely hope that next year our event may be face-to-face, or even both physical and virtual, allowing those that want to meet up in person and also those that are still in their dressing gowns not to lose out. We have asked for your view in our feedback sheets. Once again, though I cannot promise breakfast if it's going to be a virtual event. We'll be sending you a link to our presentations later today, so you can watch these again if you choose. You can like them or share them on social media as you see fit, please. And personally, as I'm sure we all feel the same way, we look forward to lockdown easing and our lives reverting back to the pre-COVID rules. A trip to the cinema, a meal out, a trip to the pub. Someone did say to me the other day that they were not relishing going back to the pub for a gin and tonic. This seems only because they would find out that the measures they've been enjoying at home over lockdown were probably triple measures, and they need to cut back to a single shot. However, a double shot is needed to progress with our vaccination rollout, but it is good to see and hear that this gathers pace, providing a route out of the current stay-at-home regime. With such optimism, it would be nice to think the expression that we wouldn't touch them with a barge pole no longer forms part of our government policy in tackling the pandemic. But either way, the vaccination programme accelerates and there should be sunshine and warm weather to follow. So let's look forward further into 2021 rather than look back at a rather dark and troubled 2020. Finally, I extend my thanks and gratitude to you all for your ongoing dialogue with Scotland Bland and particularly for joining us today. Thank you.